if you look back at history, silver has always been the money of the people. It has been like taken away or demonetized since the mid to late 60s in most Western countries. But I think that if you look back at 1980 and 2011, you had two major crises there. The first one was the dollar crisis. I don't remember it, but I've read about it that in the late 70s, like 78 and 79, the U.S. Treasury issued what they called Carter bonds. They were U.S. Treasuries denominated in Swiss francs and Deutschmarks because no one wanted dollars. So yeah, in January 1980, yes, the Hunt brothers did try to corner the market eventually, and the regulators stepped in and stopped people from going long silver, and it stopped moving silver up to 50. But Paul Volcker was the chairman of the Federal Reserve, and I've read that he's commented after the event that there were some brokerage houses that were in trouble that could have gone under. It could have brought probably the whole banking system under. Eventually, he had to allow short-term rates to go to 20%. A few months later, or back in 81, 10-year treasury yields rose up to 15.5%. So yeah, I think silver was like the canary in the coal mine, so to speak. And in 2011 as well, when we almost touched 50, that was right at the beginning of the sovereign debt crisis in Europe, which was an acronym for Portugal, Italy, Ireland, Greece, and Spain. And eventually, in the summer of 2012, Mario Draghi, the president of the ECB, he came out and said, we're going to do whatever it takes to save the euro and stop this sovereign debt crisis from spreading. And whatever it takes, of course, it wasn't raising rates like Paul Volcker did in 1980, because nowadays, Elijah, there's so much debt in the system that you can't raise rates anymore to solve a crisis. You've got to cut and print more. Yeah, that's the problem nowadays. The debt is so high, raising rates doesn't solve anything. They raised rates in the 80s to bring back investors into the dollar. They did that in 1992 here in the UK as well. When the pound collapsed, they raised rates to try to attract investors. They reversed those hikes very quickly. But nowadays, the system is so leveraged that they have to they'll have to cut or print more, move above, towards 50 or even above 50 in silver, which I think is highly possible, would signal as a crisis. I don't know. We will find out. I think it will probably be afterwards, just like it was kind of in 1980 and in 2011, or it could be concurrent as well. And what could it be? Well, you were asking me about the Japanese government bond market. Japanese long-term government bond yields have been spiking massively in the last 18 months. They've gone from being near zero and sometimes even negative, like in the 10-year, to now being 1.6 in the 10-year and above 3% in the 30 and 40-year. In Japan, the Japanese government debt to GDP is like 250%. And I've even read, Elijah, that they've doubled in the last year. And that's like a staple of their diet. So the Japanese central bank, the BOJ, is really between a rock and a hard place, because they can't really cut, because their CPI is running like at 3.5–4%. Yeah, and if the Fed can lower the short-term rates, they can influence the short-term rates by lowering the Fed funds target, but it might actually make the longer end spike. And I think that's what Powell is concerned about, because ever since the Fed cut rates back in September of 2024, September 2024. It's just that it was September 18th. That's why I got confused. They cut rates by 50 basis points, and they cut again twice to right now as we speak here. We're at 4.42. So if anything, it could actually hurt the longer end. Investors might be spooked. And why is that? Well, I think, Elijah, it's because you've got the stock market at all-time highs. You've got a lot of commodities, gold and silver included, at all-time highs. The economy is not really in a recession, even though it's slowed down. It's still doing well. Wall Street is ticking along. So to cut rates right now would be like petrol into the fire, and coupled with the debt situation and the deficit, that wouldn't help. That wouldn't help the finances, and it would probably drive actually the U.S. into a recession. While they're highly significant, the 35 level was like a really big resistance. We tried to break through there twice earlier this year, and it failed. And as you said, it's like almost 14-year highs. And there are a lot of speculators and traders who use these momentum, these breaks of very long-term levels as a way to get into the market, and they push the market higher. I think it's called the turtle trading system, which was devised in the 80s by a hedge fund trader called Richard Dennis. And he looked at 22 and 55 day levels. If you broke new highs or new lows through 55 days, it was very bullish. But so here we are, we're breaking 14-year highs. So I think it's very bullish. We reached $39 and change earlier this week. It's come back off mainly because I think the bullion banks, the swap dealers, if you want to call them, they're short quite a bit, and they're trying to fight the market. But I think we're going to continue to see the market move higher. They are kind of under control right now. But I saw, Elijah, that SLV ETF, and it was Bob Coleman who posted this on X. Apparently, the bullion banks are unable or were at a certain day not to borrow the shares to go short. So things are very tight, and a lot of physical silver is being drained from the London Bullion Market Association, or LBMA. We are at very long-term lows in terms of inventory. There, I think it's only 155 million. So yeah, the technical picture looks good. I think the next target could be in the mid-40s. And we could see that quite soon, I think. So the other thing is that silver seems to be now outperforming gold slightly. And that's always positive, not just for silver, but even for gold going forward. Yeah, that's right. And I think the above ground inventory, you're making, excuse me, it's more profitable right now to scrap silver because the price is going up, but I still think it's not really that great. So that's going to push things even higher because, the deficits that the market has been running in silver, that will be negated in years, not in months, because there's not too many primary silver producers, and to start takes time. You as a silver mining explorer, it takes years to drill for the silver, and then to get all the permits and everything. And then you've got the political risks, like in Mexico. Mexico is a big producer of silver. I saw recently that their government are not going to issue new licenses for open pit mining, or it could, So, the other thing, it takes a few years after you drill for the silver. You got to build the plant and then start processing. Taking out of the ground, it takes 3, 4, 5 years. So the prospects, fundamentals are still good, supply and demand for silver. And on the other hand, I think silver has been capped down through the infinite amount of paper that the COMEX and LBMA create via their, it's called, I think Eric Young called it the exchange for the physical doom loop. And I think that's coming under pressure. So that will drive the price higher as well, because they're not really trading real physical silver there. They're trading paper. And eventually, when people really need the physical, they're going to have to cover their shorts. Yeah, it looks like the silver market's got a lot more depth in the past. I think it was last week they did that. It would have driven the market lower, and it would have stayed there for maybe days or weeks, and it was only a matter of an hour. The market came right back, and I worked as a futures and options broker for government bonds. I did trade a bit of commodities, gold and silver as well, but if I got an order from a client, a big order, the client usually used to tell me, please, I'll leave you the order and you work it because it's a big order. So I would sell a little bit every 10 minutes or so. I wouldn't go into the market and just dump everything because I'm trying to get the best price. So yeah, I agree. You see a lot of that, unfortunately. And I've been seeing that for over 20 years in gold and silver futures, because even though I didn't trade the futures in gold and silver that much, I kept an eye on it, and I would see these smashes. And yeah, it seems like now, yeah, that's right. Let's say a lot of these bullion banks or whoever's doing this manipulation, they know the key technical levels below, and they know that a lot of people are working what's called stop loss orders for their long positions, and a lot of times they leave them GTC, which is good to cancel. So let's say right now there's probably a lot of orders out there to sell if silver breaks, let's say 34.95. Let's say, because just below that 35 level. So of course we're not near there, but if we were, big orders come in for a client. It could be even for a client, but the client doesn't care. They've made money, so they'll just like just dump the whole order in, hoping that it would trigger that 34.95. The client will get filled. It's fine. They've made money, but then it triggers those stops, and the market continues lower, and you'll probably find out. I mean, I don't have proof that like the bank, whoever sold that for a client, they did that for themselves through another account. So they'll be able to cover it, let's say at 34.50, because it just goes through like a vacuum. Yeah, that's what's been happening. That's what happens, especially in silver, because it's a much smaller market than gold, but it happens in gold too. Yeah. And I think the open interest, I haven't looked very closely, but yeah, the open interest on COMEX is dropping both gold and silver, which means people are more interested maybe in buying physical, and the demand for physical basically is outside the US, maybe more in India.